Good afternoon and welcome to Pabrai Wagons Fund Semi-Annual Investor Call. At this time, all lines are in listen-only mode. Following the opening remarks, we will conduct a question-and-answer session. If at any time during this call you require immediate assistance, please press star zero for the operator. I would now like to turn the conference over to Mr. Khan Tran, Fund Distribution Manager at the Pabrai Wagons Fund. Please go ahead.
Thank you. Good afternoon and welcome again to the Pabrai Wagons Fund Semi-Annual Investor Call. We are glad you can join us. Before we begin, let us start with the usual disclosures. Mutual fund investing involves risk, including the potential loss of principal. The fund is non-diversified, meaning it may focus its assets on fewer individual holdings than a diversified fund. Therefore, the fund is more exposed to individual stock volatility than a diversified fund. The fund may invest in small and medium capitalization companies, which involve additional risks such as limited liquidity and greater volatility than larger capitalization companies. The fund is new with limited operating history, and there can be no guarantee that the fund will grow to or maintain an economically viable size. Past performance does not guarantee future results. Opinions expressed or subject to change are not intended to be forecasts of future events, a guarantee of future result, nor investment advice. Future holdings and allocation are subject to change at any time and should not be considered a recommendation to buy or sell any security. On the call today, we have our portfolio manager, Monish Pabrai, our senior analyst and senior vice president, Fahad Mismar, and our vice president, Jaya Velachela. Now, I'd like to hand the call over to Monish Pabrai.
Thanks, Khan, and welcome shareholders to the second annual semi-annual investor call of the Pabrai Wagons Fund. I am excited that all of you are on this journey with us as partners and investors. Before we get to your questions, which are my favorite part, I'd like to first say a few words about who we are and where we are today. The Pabrai Wagons Fund launched on September 29th, 2023, almost 12 months ago. The fund seeks to invest in high-quality businesses and circles the wagons, quote unquote, around its highest conviction holdings. We look for great franchises that are being offered at substantial discounts to their underlying intrinsic value. When we find them, we try to hold on to them for a long time. From time to time, we may invest in special situations like merger arbitrage opportunities where we believe the odds of success weigh heavily in our favor. Our focus is on finding the great businesses wherever they may be around the globe. As of June 30th, 2024, the fund's 27 securities took us to Turkey, the United States, Canada, Europe, China, and Mongolia. We are concentrated with the top 5 positions making up over 45% of the fund. Our investments reflect 4 core allocations, which together accounted for 94% of the portfolio on June 30th, 2024. These 4 buckets include, first, our Turkish workhorses like Coca-Cola, Icecek, Anadolu Efes, and TAV Airports, a handful of U.S. metallurgical and thermal coal businesses, a select few group of U.S. car dealerships, and a select few quality U.S. home builders. I should also add that our first bucket is really, broadly speaking, 2 separate bets. One is on these beverage brands mainly, and the other is on TAV Airport. So it's really almost, you can think of as 5 buckets instead of 4 buckets. Most of our investments reflect corners of the market that are out of favor. For that reason, they have fallen prey to what we believe is serious mispricing. This pricing dislocation presents us with opportunities to make investments that we believe can compound our capital for years to come. With regard to our performance since inception on September 29, 2023 through August 31st, 2024, our retail share class was up 21.54%, and our institutional share class was up 21.86%. The S&P 500 was up 33.5% in the same period. The fund was meaningfully ahead of the S&P 500 6 weeks ago, but fell behind in August. Our recent underperformance was due to price action in some of our key holdings, which we believe is temporary. We are very bullish on the fund's prospects from here. Our singular focus is to beat the S&P 500 over the long run. With that in mind, it is important to situate the S&P 500 today in its historical context. In September 2000, the S&P 500 traded at a frothy trailing price-to-earnings ratio of 25.6. For more than the next 11 years, the S&P 500 delivered near zero returns, inclusive of reinvested dividends. It was not a fun ride. History does not repeat itself, but it does rhyme. Today, the S&P 500 trades at a trailing PE of 27.2, even higher than its level in 2000, and significantly above its long-term average of 16. It is entirely possible that the S&P 500 continues its upward trajectory for the next few quarters before reverting to its long-term multiple. While the S&P 500 has historically been a great choice for long-term compounding, buying into it at a trailing PE over 25 can be a risky proposition. By contrast, the Pabrai Wagons Fund's underlying portfolio sports a PE of 7.5. I love what we own, and I'm very pleased with how the fund is positioned today. Finally, a note on our brokerage platforms. The Pabrai Wagons Fund is currently available on Vanguard, Interactive Brokers, and Pershing. We are working to be added to Fidelity and Schwab, but both platforms require expressions of interest from their existing customers. So if you are interested in seeing us on Fidelity, Schwab, or any other platform, please email us on info@wagonsfund.com, and we can provide you with more information on what you can do to help us get on these platforms. We very much appreciate your support on this. And now I will pass the floor over to Fahad Mismar to take us through our pre-submitted questions. Fahad?
Thanks, Monish, and thanks to all investors who pre-submitted their questions. The first question is about the fund's investment in Coca-Cola Icecek. CCI has faced boycott pressures from consumers in several of its predominantly Muslim countries, given the Coca-Cola company's perceived ties to Israel. In some countries, homegrown cola brands have risen dramatically in popularity, displacing Coke. How do you evaluate this headwind in the context of CCI's long-term prospects?
Yeah, that's a great question. And Coke has a very old history. The company's been around for, I think, around 138 years or so. And I remember when I was in high school in Dubai, Coke was actually banned in Dubai and the United Arab Emirates for somewhat similar reasons to today. I mean, there was a concern then about its ties to Israel and such. And of course, today and actually for several decades, Coke has been now freely available in the United Arab Emirates and Dubai. So I think in the 138-year history of Coke, there's been plenty of countries where, for a variety of reasons, they may temporarily or even for longer periods face issues related to geopolitics. And from our perspective, these types of situations are difficult to handicap and difficult to forecast and difficult to kind of figure out what the trajectory is. What we are able to hang our hat on is that Coke is sold in 200 countries, and in something like 180 out of the 200 countries, it has leading market share. It's interesting that the Coca-Cola company on their website highlights countries and regions that they consider problematic from a penetration point of view. They're either unhappy with the distribution partner or bottling partner, or in some way are seeking a change to the situation. And amongst these areas that were problematic countries or regions from Coke's perspective used to be Uzbekistan. I think they may still have some concerns about Bangladesh, and most of India, all of India, is a concern. Now, Uzbekistan is a very interesting case because a few years back, that bottler came up for sale via an auction, and Coca-Cola Icecek was encouraged to bid on that auction, and the Coca-Cola company told them that to bid pretty much any price to win that concession, because they were very unhappy with the bottling arrangement in Uzbekistan. And of course, Coca-Cola Icecek said that they have a business to run, they can't really play any price, but the Coca-Cola company told them that they would sell them the 50% of the bottler that Coca-Cola company owned in Atlanta at a well below market price in order to make the overall deal palatable, but they really wanted them to get that country. And so Coca-Cola Icecek prevailed in that auction. Uzbekistan became, and this just happened, about 2-3 years ago, Uzbekistan became one of the new countries that was added to Coca-Cola Icecek, and the Coca-Cola company sold their portion of that bottler at a much lower multiple to Coca-Cola Icecek. Analysts at that time were very critical of the transaction, where they said that even with the reduced multiple paid for the Coca-Cola company's share, the overall deal still was very expensive. They had paid something like something north of $300 million for around $20 million of pre-tax earnings. So it looked like a very rich multiple. If we fast forward to today, which has just been about 2 or 3 years since that deal took place, earnings have, I think, more than quadrupled, or there might be pre-tax over $100 million at this point. And so they've gone up 4 or 5 times because the bottler was very undermanaged. And it looks like a extremely compelling deal at this point, which is why the Coca-Cola company was so interested in making a change. And Uzbekistan is an example of a bottling franchise that maybe comes up for sale once in 50 years or 100 years or 200 years. So these things don't come along every week because these bottling arrangements, certainly I cannot imagine circumstances under which Coca-Cola Icecek would want to sell that sell that country's bottling rights. And more recently, the Coca-Cola Icecek got approximately half of the country of Bangladesh, which is a very significant market. And so if we look at Coca-Cola Icecek, I mean, I would say that they are bottling in Pakistan. They are bottling now in Bangladesh. And if you know your geography, India sits in the middle of those two countries. And the Coca-Cola company is unhappy with their bottling arrangements in India. I mean, we view it as low probability, but not a zero probability, that in the next few years there's some possibility that some portion of India, Coca-Cola Icecek might at least get a chance to bid on. And, there are possibilities of a game changer situation if that were to happen with the most populous country in the world, where Pepsi dominates because of the poor showing by Coke. And so when we look at the Coca-Cola Icecek bet, we are more focused on they brought in really a rock star CEO who we met last year. Really was blown away when we met him. Really surprised that they were able to hire someone of his caliber. Karim is really exceptional, and our bet is partially on what Karim can do with their existing footprint. Coke is in many ways a simple business, but also in many ways a very complex business. And the per capita consumption of Coke is very heavily correlated to per capita GDP and the climate of each country. And there are a lot of underpenetrated regions within Coca-Cola Icecek footprint, and someone like Karim could really make a difference there. So our situation is that the boycotts, etc., are kind of difficult to handicap. We don't think it makes sense for us to exit because of things or related to that. I think we just want to play the long game on this front, and we like the power of the brand. We think it travels really well, and we like the management, and we like the group that has the ownership and the promoter of the company in Turkey. They're all exceptional. So we hope to keep this investment for a while.
Thanks, Monish. Next, we have a few questions about our coal investments. The first one is, I can see significant value in looking at the remaining life of our coal businesses and their ability to continue generating cash returns for us as shareholders until they run out of coal. However, should we account for the volatility of coal prices when assessing their remaining cash flows to arrive at accurate fair value? A year ago, coal companies were generating a lot of cash and returning it to shareholders. The situation has changed today as prices have fallen. How do these swings impact your assessment of the intrinsic value of these businesses?
Yeah, that's a great question. Last year, when we were first looking at some of the different thermal coal and metallurgical coal businesses, their prices and valuations made no sense to us. They were priced as though they would be out of business in a few years. And I mean, to give you an example, just one of the businesses, Consol Energy, which is actually a thermal coal producer. And Consol is an interesting business because they forward sell almost 100% of their sales for the next 12 months are already locked in and they're also locked in with minimum and maximum prices, floors and ceilings. So Consol, for example, has no possibility of having negative cash flows or any kind of financial issues in the next 12 months. And then when you look out beyond that into year 2, about 50% of the output has been sold similarly with contracts and floor and ceiling prices. And we go to year 3, it's about 25%. So, and as we move forward, let's say in the next 6 months to a year, the second year will also get locked in and so on. And they're a low-cost producer with some of the highest quality thermal coal, and this thermal coal has many uses globally that are unrelated to the production of power, and they are critical resources required for those industrial applications. So Consol, when we had looked at it last year, I think had a market cap of like 1.8 billion or so. And it was a business that was unlikely to pretty much ever have a year where their cash flows would be less than 200 or 250 million. And it was likely to have many years where those cash flows might be north of 500 million. And this, if we just consider 250 to 500 million, though it could even be higher than that, of these cash flows for several decades, we didn't think that a 1.8 or 2 billion market cap made sense in terms of the discounted cash flows coming out. And when we had looked at the different coal businesses, we stress tested our different scenarios, and we absolutely understood that there could be periods where pricing could be weak and cash flows could be weak and cash flows could even be negative. And we considered the situation of what it might do to the franchise value and equity value of these companies long term. And we concluded that all of these businesses that we've invested in, for pretty much the first time in the history of these various businesses, they have no debt. They're net cash positive. And typically, mining businesses historically have never been like that. They've always been highly levered. And it's usually the leverage that's done them in, because basically when the downturn comes and their cash flows are stressed, they do not have an ability to service the debt, which leads to a restructuring and bankruptcy and so on and so forth. These companies all went through some serious stresses in the last decade or two. And of course, their situation today is very reversed, where they are actually net cash. And also what these companies have done for the most part is that the ones that are buying back shares have very strict requirements of minimum cash below which they're unwilling to go, even if their stock price is very attractive. And so we really couldn't see a scenario where the franchise value or the equity value and or the ownership that we have would be threatened long term during periods when cash flows are weak. One of the things about this business is there's an asymmetry. So if we look at the metallurgical coal producers, today, for example, the main index, the Premier Low Vol PLV index in Australia, which is the primary index globally, is currently at about $185 per ton. It recently bottomed out at $176 per ton. At the $185 per ton, a significant amount of U.S. production is underwater. They're not able to cover their cash costs. And many of these players have very healthy balance sheets because in the recent past, coal prices were very strong after the war in Ukraine and so on. So they have an ability to, kind of withstand low prices for some time. But already, for example, something on the order of, we think around like maybe 5 or 10 million tons of, at least around 10 million tons of capacity outside of our holdings is underwater, likely to shut down. And when these mines shut down, the asymmetry is that they really have a lot of difficulty coming back. So if I were to contrast this with some other industries, like let's say, for example, the office building industry. So historically, what has happened in commercial real estate, like offices, for example, office towers, is things get tight, there isn't much availability, and rents start to go up a lot. And almost at the same time, a large number of new office towers are proposed and announced, and construction begins. And it takes about 5 years for these office towers to come online. And so typically what we'd have about 5 years after a major boom is you would have a glut of supply because all these towers are coming on going live at about the same time, and rents collapse. And then when rents collapse, there's a freeze on new construction because economically it makes no sense, like what we have today in the office market in the U.S. There's a serious glut of space, and there isn't much new construction going on in offices. But basically, there is no structural situation that prevents new office towers from being announced and built when rents are high. In the coal business, what happens is that when prices collapse, like we have right now, and a mine is shut down, basically the equipment gets pulled out, the workers are let go, the permits are gone, and that mine is not operating. So the PLV 185 or 175, that mine, let's say, is not operating. And let's say at some point the index goes to 250 or 300 or 350, at which point that particular mine would be very profitable. It does not really have an ability to come back at that point because equipment lead times today, which are not boom times, today equipment lead times are 2 years. If there were a boom in if there was a boom in coal prices, those equipment lead times would be further stretched out, could be even 3 years or 4 years. So you can't get the equipment, and the workers are not available. So mine workers who were let go, they may have retired or gone to another profession or whatever else. When you're trying to hire specialist miners, you cannot create them overnight. And so the workers are not available. And then the capital also is not available because if the index is at 300, there's no nothing written in stone that 6 months from now, 1 year from now, or 3 years from now, it'll still be 300. So debtors are not willing to provide capital. Investors are not willing to provide debt capital. And equity capital is also not available because of the volatility of coal prices. And coal is a 4-lettered word. A lot of banks and a lot of financial institutions will not invest in coal, even if the economics are great. So for a variety of reasons, when this production goes away, as we are seeing it go away currently, that production is not coming back. And the met coal markets are slightly, I would say, undersupplied or fairly supplied. There is no real oversupply. And so when we get any kind of even a modest tailwind, prices could go up a lot and supply would not be able to respond. So it is our view that our businesses that we've invested in have very strong financials. We don't see any of them having any stress at current prices and current index prices and all of that. And I think they'll be a strong beneficiary when things turn. So when we did our work on the coal businesses, we considered a variety of situations in terms of cash flows, negative cash flows, modest cash flows, euphoric cash flows, and stress tested these businesses. And we didn't really see any kind of modest or high probability that these businesses would have, an inability to survive these volatile times. So we liked the bet and we would keep them.
Thanks, Monish. What are your thoughts on the merger of Arch Resources with Consol Energy? Are you bullish on the combined entity? They have been better off as separate entities. Is it a negative that the companies cannot buy back shares until after the merger? And how will this merger ultimately affect the Wagons Fund?
Yeah, we were surprised when the merger was announced, and we were shareholders, of course, in both companies, and we obviously like both businesses. One of the big positives that comes around when you put these two companies together is it reduces the odds considerably that there would be any meaningful periods in the future where the combined business would have negative or stressed cash flows. So, for example, if you look at the current situation today in the coal markets, the thermal coal markets are quite healthy. The API2 indices, which are what a lot of thermal business is tied on, is in a very healthy place right now. And Consol is producing very healthy cash flows at this point. Arch Resources, which is predominantly a met coal producer, it has what they call long wall met coal operations, and it's a low cost producer. It sits fairly low on the cost curve. So even in a current 185 PLV, Arch is cash flow positive when a lot of U.S. players are not cash flow positive. So today, if the companies were combined, there would be very healthy cash flows coming out of this entity. Both companies had bought into basically reducing or eliminating their dividends and not really focused on anything else other than using their cash flows to buy back shares. And both of the companies' stock prices are quite undervalued relative to the cash flows they are likely to produce for the next several decades. So basically, we would be surprised if the combined entity really runs into any meaningful periods in the future where they have stressed cash flows and are unable to do buybacks. We think that scenario would be quite remote because I already said that Consol, for example, forward sells a year in advance and they lock in those margins. Arch forward sells with floating prices, but because they sit low on the cost curve, they would likely always be making money. And the combined company, I think, would always be making money. And we think, so, if you think of the combined entity around, $5 billion odd market cap, we think in a bad year, they would produce something like $500 million of cash flow. And in a good year, could produce over $1 billion in cash flow. And if you just think of a company that's buying back 10 to 20% of its shares every year, that's a spectacular situation. Now, I don't think they'll be able to, I don't think the stock market cap will be $5 billion when they are producing more than $100 million a month in cash flow. I think the market would adjust the market cap. But, from our perspective on a total return basis, that's fine with us. I mean, actually, I would prefer if the market cap stayed low. But overall, we think that's a worthwhile bet for us to make, and we like to keep those companies for as long as we can.
Thanks, Monish. The next question is, what gives you confidence, or what mental model are you using to avoid investing in NVIDIA amidst an AI boom where NVIDIA is the only real player?
Yeah, it's a good question. I think that when I look at any businesses, and I would say many parts of NVIDIA would be outside my circle of competence. So that'd be the first reason that we don't have an investment in NVIDIA. But the thought exercise that I would want to run with a business like NVIDIA, I think NVIDIA recently had a market cap that was north of $3 billion, and it's gone down a little bit. It's about $2.8 billion or so now. 2.8 trillion. It was over 3 trillion. So it's 1,000x different. Sorry about that. But anyway, so it's either 3 trillion or let's say 2.8 trillion market cap. And the thought experiment I'd like to run, in order to make an investment in it, is I would need to have some kind of a conviction on what would be the cash flows coming out of NVIDIA over the next 10, 20, 30 years, and then, discount those back to some reasonable number. Now, NVIDIA is currently producing something like $60 billion a year, approximately. I mean, these are approximate, but I really haven't spent a lot of time in the company, so my numbers are very approximate. So they're producing about $60 billion a year. And their growth in cash flows, which has been very spectacular in the last few years, is slowing down. So if those cash flows were to grow at something like 100% a year for the next several years, NVIDIA is cheap on a 2.8 trillion market cap. In other words, if 2 or 3 years from now, the $60 billion of cash flow in a single year is $200 billion or $300 billion, or maybe 5 years from now is $500 or $600 billion, that would be a cheap stock. But there is not enough data that I have that would prompt me to come to the conclusion that those types of cash flows are possible or realistic for a company like NVIDIA. I was reading the most recent issue of Barron's just came out on September 16th. They had an article on a company that used to be called Schlumberger, which is in the oil field services business. And the article was pointing out that in the 1980s, Schlumberger was the NVIDIA of the 1980s. Its stock price rise in the 1980s resembled the stock price rise that we've seen in NVIDIA more recently. And over the last 3.5 decades, so the market cap, at least what this article was saying, the market cap of Schlumberger around 1990 was about $60 billion. And today, it is around $60 billion. Now, they've issued dividends over the years, but I don't think most of us would compare it a home run, that if you held it from 1990 till today, that your annualized return would be better than the S&P or anything like that. I think it would be terrible. And my brother in high school in Dubai had interned at Schlumberger's. Their Middle East headquarters were in Dubai at the time. So he was a 17 or 18-year-old intern in the company in their accounting department or something. So I've known of the business for north of 40 years, and it's a very high quality company, and it provides very essential services. But the nature of equity markets is things can get euphoric, and if a business like NVIDIA with the $60 billion of cash flows and what I understand about AI were available, for example, for $200 billion, even someone like me might be able to go long on it, because I could probably see that the cash flows might be strong enough to make it a bargain. But the $60 billion versus the $2.8 trillion, I think just makes it difficult with my juvenile understanding of the business.
Thanks, Monish. I think now we can open the floor up to a few questions from the audience for the remaining time of the call. So I'll hand it over to our operator.
Thank you. Yep, ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press star followed by the number 1 on your touchtone phone. You will hear a prompt that your hand has been raised. Should you wish to decline from the polling process, please press star followed by the number 2. If you are using a speakerphone, please make sure to lift the handset before pressing any keys. One moment while we prepare our Q&A roster. Your first question comes from the line of Harry Wu, private investor. Your line is now open.
Hi, Monish. Could you share a little bit about your investment in Oxy in the fund? Thank you.
Yeah. When we started the Pabrai Wagons fund late September last year, mutual funds are very different from the way we run our private partnerships and so on. They have a number of, and rightly so, they have a number of diversification rules, etc. The least number of positions that we could have under the trust that we have these funds under would be something like 15 or 16 positions, more realistically around 20 to 30 positions. And usually in a year, historically, we can come up with 1, 2, 3, or 4 ideas, and we certainly cannot come up with 30 ideas or 20 ideas. It's the nature of, the speed at which I do things. And what we had done at that point was that when you look at our positions, there would be some that are very high conviction ideas. We've known these businesses for a while. We've had them as investments elsewhere and so on. And so we could populate the fund with those when we got going. We had a choice of keeping the fund significantly in cash or having some what I would consider placeholders. And so, for example, we used to have Berkshire Hathaway as a placeholder. Familiar with the business. I think it's a low downside, very well managed, etc. But it does not, from my vantage point, have the same upside potential that, for example, some of our coal bets would have. And Oxy falls into that category. I'm familiar with the business. It's an extremely well-run company with a very strong position in the Permian with their fracking. And in fact, they have been the low-cost producer in the Permian and actually done a lot of innovations. Vicky Holub is a truly a once-in-a-generation exceptional manager. And the main determinant of what happens to in terms of future returns for Oxy, the biggest driver would be oil prices. And we don't really have, a crystal ball which tells us, that oil prices will be strong in the future. But what we do know is that the U.S., for example, I think the U.S. is producing 11 or 12 million barrels a day. We are the largest producer in the world now, which is spectacular, wonderful. But more than half that production is fracked production from shale oil. And these wells, the shale oil wells, are very different from the historic way oil has been produced for more than the last 100 years or so. There are oil fields which, like I think Charlie Munger had a royalty interest in some oil field in Bakersfield, which he had bought for something like $1,000 or something 50, 60 years ago. And even now he was getting something like $70,000 a year in royalty payments and dividends from that oil field, which wasn't expected to last this long, but it did. But the fracked oil fields, so coming from shale oil, those run out in 12 to 18 months. They run out very quickly. So basically, it's like you're on a treadmill. I mean, all the return characteristics are exceptional on those oil fields in terms of capital you're putting in versus your returns at $80 or $70 WTI. It's a great business. If oil prices were to go down meaningfully, the fracked portion of the oil produced globally would dry up really quickly. And even maybe some conventional production and exploration, et cetera, would go down. So it's very different in terms of the way production changes with oil prices today versus the pre-fracked era. So some of this is similar to the coal business of the asymmetry. So we think that the Oxy bet, like I said, we put it more as a placeholder, was a low-risk bet. It has upside built in for when prices go up, and when prices go down, I think they are more resilient than most others. So that's why we have that bet in the portfolio. It's not a big bet. It's less than 4%.
Your next question comes from the line of Edward Brown, private investor. Please go ahead.
Hi, thanks for holding the call. I'd love it if you could talk a little bit about your thoughts on the home builder industry that comprises one of the four core allocations. Thank you.
Yeah, it's a good question. We own a few home builders, and we think they're all very high quality businesses. And we think they're misunderstood. And people tend to think of the home building business as cyclical. And we don't think they're as cyclical as people think they are. So the U.S. has a shortage, depending on who you talk to, of something north of 5 million homes. So, you know, we were overproducing a lot of homes leading up to the financial crisis in 2007. And I think we were producing well above the 1.5 million new housing units we need as a country every year at that point. And so there was a big glut at that point. But what happened after that, if you look at the kind of statistics of kind of the number of homes that got built in 08, 09, 10, 11, and so on, and, you know, fast forward and carry it on till today, we have not averaged anywhere near the 1.5 million, and that overhang was absorbed a long time ago. And we basically have a shortage of housing units, which is why you get this kind of rhetoric from presidential candidates that we're going to build 5 million homes or something, which is, from my point of view, a pipe dream, not going to happen. You know, you can't just flip a switch on these things. So the home builders have 2 or 3 things going on, which we think are secular trends that play to the benefit of the large national players. The first is that home building used to be very fragmented. It still is pretty fragmented, but it's consolidated a lot, where a few large players have the largest market share they've ever had. And the reason they have the largest market share they've ever had is because they have economies of scale. So when we look at a Pulte or a Toll Brothers or you know, some of these other names like TriPoint, et cetera, that we have in our portfolio, they have a structural advantage over the mom and pop players. They have a structural advantage in terms of their cost of capital. They can borrow at, you know, 5-6%, and a private player would trying to do something is going to be borrowing at, you know, double digits, 15% or something. So they've got much higher costs on the financing side. They've also got a big advantage in terms of their cost of production. So home builders now look a lot like just-in-time manufacturing. Basically, they'll put up a few models. They've basically got people walking through these models, signing contracts, and you know, some of them do spec building, but you know, all of their spec homes are mostly sold before they're completed. But a large portion is basically they start the work after there's a buyer who signed on, which means basically that there's not that much of their equity capital going in. And the other thing that many of these players have done is they're backward integrated. So NVR was a pioneer in this, where a number of, you know, portions of the home which would be built on site are now built in kind of manufacturing type production facilities and then trucked over to the home site at a much lower cost than doing it on site. So basically, and then I think that in the equity market side, just like with the auto dealers, the market caps do not reflect the long-term cash flows and growth of these businesses relative to their market caps. So we think they are a very good bet because they are very good stewards of capital. Most of them are heavily fixated on buybacks. I mean, one of them, like, TriPoint is 100% buybacks, no dividend. They bought back more than half their shares in the last few years. And so I think that's our thesis there is these are very high-quality businesses. They're not as cyclical as people think they are. There's a big shortage of quality homes. The large players have an advantage. And so, yeah, we like the position.
Your next question comes from the line of Prasad Raju, private investor. Your line is now open.
Hey, Manish, thanks for taking this question. Just wanted to ask you about the investments in Turkey. Just wanted to get your thought on since the time the fund initially invested in these companies, do you believe they are still significantly mispriced at this time?
Yeah, I think some of our highest conviction bets are in Turkey. If you look at our portfolio at the end of June, the top 3 bets are all in Turkey. And the top 3 bets, which is TAV is the biggest one, the airport operator, the Anadolu Efes is number 2, and Coca-Cola Icecek is number 3. These 3 collectively are over 33%. Yeah, I think just exactly 33% of the fund, so just slightly below 1/3. And we like that position. I think they're all exceptional businesses. I think they're very undervalued. I think they're very strong management teams, very strong franchise values, great brands, and a large footprint of earnings and cash flows that comes outside of Turkey. So we are very happy with that holding, and they are amongst the highest conviction that we have of anything in the portfolio.
Your next question comes from the line of Elias Moses, private investor. Please go ahead.
Hi, thank you, Manish. Nice to speak with you. I have a couple of questions. First of all, why do you decide that Homebuilders to buy them? I know that, as you mentioned, they're consolidated in the markets, and certainly it can be a linear, told they are Horton, that are, we can say they have a little bit more advantage since of the size and what they changed about light model instead of the heavy model that they had in the past. Why you decide that? That's the first question. And the second question, what it may change your mind in Turkey, since it can be a risk of capital flows or anything that might deteriorate your thesis of investment, that it might change your mind and say, well, even though that it's a great companies, all of them that you put it, and you say, well, maybe it's not uninvestable in some sense, not because of the companies, it's because of the government, that it might change the way you can pull out in, I don't know, in years or decades, your money out after you decide that it's already a good investment, but it's not investable in some way.
Yeah, those are good questions. So when we look at our large holdings, I'll just take the second one first. When we look at our large holdings in Turkey, these companies, like let's look at the airport operator, TAV Airports. TAV Airports has a significant amount of its revenue and cash flows coming from outside Turkey. And these are separate subsidiaries. In some cases, they are joint ventures with other entities. And quite frankly, those cash flows are outside of Turkey, and they are ring-fenced, if you will. So in a situation that you are bringing up, which I think would be extremely low probability, but in the event that even that extreme low probability event comes to pass, we don't believe that their non-Turkish assets would be in any way impaired. And we also think that their Turkish assets are so critical to the functioning of the country and the economy. Like if I look at the airport operator, TAV Airports, that in their case, they are contractually, even within Turkey, getting all revenues in euros, almost all revenue in euro, and a lot of the costs are in liras. Those are contracts with the government. Those are mission-critical airports. So we don't think that there would be a situation where, it's just very difficult to imagine an impairment which would take us below our current or our average cost, etc. And the same with Anadolu Efes. They are the largest beer company in Russia and Ukraine and half a dozen other countries. Those are very strong markets by a huge order of magnitude. Their beer volumes outside Turkey are massively more than the beer volumes inside Turkey. The same thing is ring-fenced. And the same thing with Coca-Cola Icecek. Their bottling volumes outside Turkey are meaningfully above the volumes inside Turkey. So even if you take a kind of draconian situation of something happening of where there's some capital flow issues or whatever, we don't believe that the companies get impaired to the point of going below our cost basis or anything like that. I think so that's low probability. I think the home builders, we covered most of it, but yeah, they've all, in a very slow way, many decades after they should have done it, gotten NVR envy, and they've, taken a capital light approach to the business, which is wonderful. They haven't gone all the way like NVR has, but they've gone a long ways. So all of them are moving towards more than half their lots that are controlled being optioned, etc., and working with partners for land banks and all that. So yeah, I think those the home building business is a very good business. It's misunderstood and undervalued, and the companies are very strong, good stewards of capital and doing a good job. So we like the position. Maybe we can take one more question.
Your last question comes from the line of Jason Muhlenkamp, private investor. Please go ahead.
Thank you for hosting these calls. Would like you to discuss the fund's holdings in Greece. Thank you.
I'm sorry, the fund holding in, you said Greece?
Yes, Greece. I would think Danaos Corp. Is that how you pronounce it?
We don't have any holdings in Greece.
Danaos.
Oh, you're talking about the shipping company, Danaos?
Yes.
Oh yeah. We have one position in Greece. They're headquartered in Athens. Danaos Corporation, and Danaos is more like, I think it's a very well-run company. It's more like a special situation where if you study the business, you'll find that they have locked-in cash flows that are a large portion of their market cap. And So we think that because of so equity markets hate uncertainty and they heavily punish uncertainty. And so Danaos, for example, currently is a beneficiary of the fact that ships cannot go through the Suez Canal and they have to go around Africa. And that has increased the demand and number of days that a ship's on the water for a given voyage and caused tightness in availability and led to significant increases in the daily rates of these ships. And so in the case of Danaos, they have locked in contracts and cash flows, which are almost, you can take it to the bank. I mean, those are pretty much, with the largest lines, etc. And so we just think that it's just not reflected appropriately in the market cap. And so that's why we have that position. And thank you so much for all your questions. I really enjoy these calls. And also thank you so much for your support and interest in the Wagons Fund.
Great. Once again.
Ladies and gentlemen, this concludes today's conference call. Thank you very much for your participation. You may now disconnect.